The purpose of this presentation is to give you an overview of the accounting, reporting, and analysis for insurance companies. Every industry has their nuances, and insurance is no exception in terms of how things are recorded, what the title of accounts would be, and what is the focus of any evaluation of the company. And what we're going to do is first talk about the regulation of insurance companies, then some of the basic idea of how you analyze an insurance company, and then specifically look at what are called IRIS ratios for property and casualty, as well as life and health insurance companies. The regulation of insurance companies is simple, but it's important to understand that this is an area where there may be some change due to some of the laws coming out of the subprime crisis. So we may see some changes in this, but this is the current state of the regulation. Insurance is regulated by the states because of the 10th Amendment to the U.S. Constitution. This basically tells us that anything not specifically power given to the federal government is basically by default up to the states. And this is the basis for why states will regulate insurance companies and not the federal government. There's also the McCarran Act, and this exempted insurance companies from federal laws as long as the states were regulating these companies. Now, there are two types of insurance companies. There is the stock and then the mutual. A stock company is an insurance company that is owned by shareholders, and the shareholders may receive dividends, and if the company is publicly traded, they can sell their shares and other investors can buy the shares. If the company is a mutual, then it is actually owned by the policyholders. So if you are insured by a mutual such as State Farm, you are actually an owner and could receive dividends. So there's mutual and stock. Now, all companies will be regulated by the Federal Trade Commission with regard to competition. So if there is a merger proposed between two insurance companies, then the Federal Trade Commission can step in and challenge that particular merger, as they would with any industrial corporation. Now, the SEC will regulate at least the securities of any company that is a publicly traded insurance company. So in other words, you're not going to be able to find the financial statements of State Farm on the Edgar site at the SEC's website, but you will find those of Allstate, which is a publicly traded insurance company. Now, it would be rather awkward if an insurance company operates in 50 states and what they have to provide in terms of financials and any other type of information if it's different for every state. So what has happened over time is that there's been uniformity given to state laws through the National Association of Insurance Commissioners. And what this association accomplishes is a degree of uniformity so that a company like State Farm or Allstate could operate in all 50 states and not have to have 50 different sets of regulations. So some of the uniformities with regard to the statutory financials, some of the uniformity is with respect to what we do with some of that financial information, such as the IRIS ratios, which we'll talk about in a moment. Now, in addition to all this type of regulation that I mentioned, those who sell insurance are going to be licensed by the respective state in which they are selling the product. Now, when we analyze insurance companies, we have at minimum, the statutory financials. Those are the financial statements, and they're quite comprehensive, that are required by NAIC, in other words, by the states. So insurance companies prepare the statutory financials and they file them with the state, and then eventually that information is made public, and the insurance commissioners will use that information in evaluating the insurance company. if it's a publicly traded insurance company, they also have to prepare 10Ks, annual reports, 8Ks, 10Qs, all those statements that are required of any publicly traded company. So you have a lot of information out there on publicly traded insurance companies. So you have the statutory financials, and you have the financial statements as we know them and familiar with. Now, what the state insurance supervisors do is they review the statutory financials, and they apply the IRIS system of ratios, which is just a set of ratios that give us a picture of the financial health of an insurance company, but they use other metrics as well. With respect to the IRIS ratios and a few of the other metrics, they have what's called the usual range, and it's any time something is out, any ratio ends up outside of the bounds, that more scrutiny is provided to that company. Now, how many have to be without that range? Well, it really depends on the state. It depends on what the company's history is with the state in terms of being within or outside of bounds. You have to look at the whole economic condition of the state in which the company is operating and so forth. So it's not a hard and fast rule that you must have X number of ratios outside of a range before they have further scrutiny. It is kind of a fuzzy criteria. But basically, you calculate these ratios, see if they're outside the usual range. And then the supervisors will apply risk-based capital standards and other types of analysis. And this is focusing on the capital and surplus of a company. That is, how much of a cushion is there for policyholders in this particular company? Because policyholders are essentially the, a liability. The losses that they may incur have to be taken care of, and so that is, policyholders have to worry about whether there's enough cushion there in case there's a downturn in the values of the investments of the company, so that want to make sure there's enough cushion so that the insurance company can pay the obligations. So in terms of the tools that we have in financial analysis for insurance companies, we have the IRIS ratios coming up soon. We also have growth rates and premiums. And growth rates and premiums we're looking at, is it too fast, too slow? Excuse my misspelling there. So are the growth rates too fast, or are they growing too slow relative to other companies in the same industry? What are the renewal rates? Because when you think of it, when you get car insurance, do you switch every year or do you stay with the same company? Well, people tend to stay with the same company. But if all of a sudden the renewal rates are declining, that may show some loss of market share for that company and some type of decline. So that would require us to look further. There's also, if you have that much information, you could calculate the premium per policy. The premium per policy will give you an idea if they're charging more for a given policy than before. Are the rates changing? For example, if a particular line of insurance is getting riskier, then they would be raising the premiums on those particular policies. So you can look at that. If you can get the number of policies in force from their disclosures, you could then calculate the premiums per policy and look at that and see if it changes over time. There's also the dimension of reinsurance. The question always comes down to what portion of policies are reinsured, that is, an insurance company insuring another insurance company, and what's the financial condition of the reinsurer, because that will affect the insurance company that's the subject of the analysis. And looking at reinsurance is important. It's not that reinsurance is bad, but how much is it being used, and is there a change in how it's being used? That is there a trend in more reinsurance over time or less? So let's take a look at basic insurance. In basic insurance, you sell a policy, collect the premiums over time, and the premiums are invested. Now, if there's actually a loss, then there's a payout on the policy. So some of that investment that has been made is going to be paid out to the policy holder. Now, you will find that the collection of premiums don't always line up with the calendar year. So there are going to be some premiums that are earned during the period, that is for policy in force during the year, and some that are not earned as yet because you've collected them but you have not, they're for part of the policy that hangs over to the next year. So that if somebody takes out a year-long policy in September, then what's going to happen is that's going to be good through August of the next year. Well, at the end of the fiscal year, though, you've got some of that premium has been earned during that period, September, October, November, December, but there still remains 8 months that are unearned, and so that's going to be part of the unearned premiums that you'll see in the financials. Now, how does reinsurance work? Well, reinsurance is basically insurance of an insurance company. So suppose we have these different policyholders and they pay premiums to the insurance company, and in return the insurance company commits to protect them in the event of losses that meet certain requirements. Now, an insurance company can reduce their exposure to some risk of some type, whatever this is, type of policy this is, by getting an insurance policy from another insurance company. And there are companies that specialize in reinsurance. And you'll notice that often their name has RE in it, so General Re, Swiss Re. Those are reinsurance companies. So what the insurance company is doing is ceding. Ceding is basically insuring their insurance, ceding it to a reinsurance company. Now, why would you do it? Well, a company can, if they look at their portfolio, which is a portfolio of policies they've committed to, they may want to limit the fluctuations and the losses. So there may be some, maybe perhaps not everything's as well diversified as they thought in terms of their portfolio, so they may want to shift some of that risk to the reinsurance company to reduce the fluctuation that they have within a given fiscal period. It also may be the case in certain types of insurance that they want to offload some of that insurance risk because it's just simply too large. It may be catastrophic risk of some type. It may be, say, an earthquake risk, and they don't think that they can bear all of that because it's not going to, in a given area, that'd be a lot of property damage, for example, in the event of an earthquake. And that would be a lot for a particular company to handle. So it's sharing that by buying insurance from the reinsurance company. So what happens is if there is actually a loss on that policy that for which there's reinsurance, then they actually, money flows to the insurance company and then it flows to the policyholder. And the policyholder isn't going to really know about the reinsurance company behind their insurance company. But it may be there. A lot of companies, insurance companies, do reinsure losses, and there's good reason to do so in many different types of policies. So reinsurance is insurance of the insurance company, and it can be done on a policy-by-policy basis, which is facultative insurance, or it could be what's called a treaty, where basically the reinsurance company provides insurance for an entire portfolio of policies that the insurance company has. So it can be one by one, a specific policy for a specific company that's reinsured, or it can be the entire portfolio for the insurance company. Now let's take a look at how we analyze companies. When we analyze premiums, we look at the growth rate in the premiums. And this is like looking at the growth rate of revenues of an industrial company. You also look at the renewal rate. That is policies and how often they're renewed, and if they're renewed with the same likelihood as they were previously. You look at the change in premium per policy. You also look at cession rates. That is, we're talking about ceding or getting that reinsurance. So what is the rate of reinsurance? So what portion of the premiums are actually reinsured? And then, so there's shifting of risk there. Now the complement of that is the net retention rate. That's the premiums that are not ceded, not reinsured. And then you have maximum event retention. That is, what is the most they'd have to pay out in the worst case scenario? So in the event of that earthquake or in the event of a hurricane, what is the most that they would have to bear themselves? So regardless, if we're talking about what that particular insurance company has to bear. So we're not going to think about what portion has been ceded, because that's not going to be borne by the insurance company in the end, but how much does that particular insurance company bear in the event of a catastrophe. We also look at things like claims ratios, and claims are the losses. That, if you damage your car and you make a claim, those are the losses, divided by the earned premiums. There's also expense ratio, because there are expenses that the insurance company has, for example, legal expenses, adjuster expenses, and so forth, compared to the premiums policies sold in a period. The combined ratio, you just simply add those two. So we're talking about losses and expenses compared to premiums. And so you can think about that. A high ratio would indicate high losses or high expenses, which would not be a good thing. And then investment income ratio is simply looking at the investment income divided by the premium. Now the IRIS system that I've mentioned before, it's simply a collection of ratios and a specification of what is usual. Now, if you look at different descriptions of the IRIS system, you're going to see that there are different usual bounds, because these have changed over time. So if you look at what is considered the usual boundaries for some of these ratios, 5-6 years ago, it may be a little bit different than what you see today. So it is a system with a little flexibility in it. Now, there's one system for life and health insurers and one system for property and casualty insurance. And the reason we have these different systems is there are different types of insurance in terms of when the claims would occur relative to when the premiums are received. And so you would look at different dimensions of the insurance company in that case. Now, they are adopted by the National Association of Insurance Commissioners, and they are used by state regulators. And you'll see in many insurance companies' disclosures a discussion of their IRIS ratios. I should also mention, if you look back in IRIS ratio systems, you'll see a different number of ratios over time. So if you looked a few years ago, you'd see, say, 12 for P&C, and now you see 13. So this will vary over time. So it is a system that is tweaked a little bit to keep up with what's going on. So it's not a static system. Now, IRIS ratios aren't everything. There are other sets of ratios. There are other standards like risk-based capital standards. Now, risk-based capital standards, when we use that phrase, what we mean is having enough capital, which in this means that cushion for the policyholders, which in an insurance company would be long-term debt and equity, having enough based upon the riskiness of the assets. So if you have two insurance companies, one's invested just in treasuries and the other's in treasuries and mortgage-backed securities, the one with treasuries and mortgage-backed securities, even though the value of the portfolio might be identical, they would have to have more capital on hand under risk-based capital standards. There's also something called fast ratios, and there's a whole system that different insurance commissioners will use. But IRIS ratios are consistent across all 50 states. And of course, lately there's been a lot of talk about using stress tests, and some of these states are doing this. And you're looking at solvency in the worst case scenario. Worst case scenario in terms of losses, but also financial variables like yield on investments and so forth. Now, an analyst will often consider long-term debt and equity to be capital because the policyholder's claims should come before those of the debt holders and shareholders. So if you have a long-term debt holder, they are behind the policyholder when it comes to claiming any assets in the event of a liquidation of the insurance company. So the focus on evaluating a solvency is whether or not the claims can be paid when required. Now, there are two systems with the IRIS ratios, as I mentioned, property and casualty and life and health. In the property and casualty system, we have 12 or 13 ratios depending which system you're looking at. We have overall ratios, profitability, liquidity, and reserve. Now reserve is setting aside funds for losses, and so it is allocating and setting aside some assets that are necessary to meet potential losses. So those are very, very important, as you can see with a property and casualty insurer. Now let me show you the ratios here. For example, the gross premium written to policyholder surplus. Now that particular ratio is for an industrial company would be similar to taking revenues and dividing it by equity. And this is a type of turnover ratio. So it is a form of a turnover ratio. Now in state regulations, you will often see the minimum and maximum stated as whole numbers. So the minimum acceptable 0% or 0 if you're going to use just the whole numbers. The maximum is 900% or 900 if you use the whole number. So you will see them drop the percentage sign in a lot of the write-ups. Now net premium written to policyholder surplus is very similar. It's very similar to gross premium written. The difference is how much has been ceded to other insurance companies. So basically, we're talking about how the difference between IRIS 1 and IRIS 2 has to do with how much has been reinsured. And then you have ratios such as change in net premiums written. Writing a premium is selling a policy. So change in the net premium written, and so net premiums again is after you consider what's been reinsured. So you have the change in the premium, and basically there's a minimum and maximum. You don't want to drop off, you don't want business to drop off that much, but at the same time you don't want to grow too fast, because if you grow too fast you may not build up the capital necessary to support that. So that's why there's a minimum, but there's also a maximum there. If you grow too fast, that'll be a caution flag for them. Now surplus aid is a funny term that you'll see, and there is a set of terminology I'll provide you with, but the surplus aid has to do with the amount that is reinsured. So surplus aid relates to reinsurance. So if basically when you sell a policy you book a gain, and that gain goes into the policyholder surplus, you basically, that surplus aid is saying, okay, but how much of that surplus is due to the what we've reinsured? So what has the insurance company gone out and insured? You don't want surplus aid to be that big a part of policyholder surplus. Now policyholder surplus is analogous to equity, and you'll notice a relationship between that and equity for your publicly traded insurance companies. There's also to your overall operating ratio. There's investment yield. You look at the change in policyholder surplus. You know, you don't want to grow too fast, but you don't want it to drop off. And then net change in adjusted policyholder surplus. Again, those are with certain adjustments in there, but we won't go into the gory details there. Liabilities to, liquid assets. So this is a little different than you're used to. Instead of analyzing an industrial company, we typically look at what we have in liquid assets compared to obligations. So this is flipped upside down. So what are the liabilities to liquid assets? And you'll see that the maximum there is 100%. So when you look at that, the liability shouldn't be more than the liquid assets. Now gross agents balance to policyholder surplus. Gross agents balance has to do with, it's similar to a deferred account. It's what hasn't been paid yet to the agents who sold the policies. The commissions on these policies is very high in some cases, and so that could be the full first year premium on a policy. So it's a substantial amount, and it's something which is a type of deferred account. So we want to look at how much is around the corner that the company has to pay. Then the next two deal with reserve development, how much you've set aside, and you want to make sure you set aside enough. You don't want to set aside too much, but you want to set aside enough. And then and the last one is a more recently added ratio, and it's estimated current reserve deficiency. So each year you look at the policies and you see what you have out there, then you try to figure out what are the estimated losses, and if you don't have it reserved to that amount, then you are going to book some more losses this particular year. So you do not want to be that deficient in a given year. So it tells you something about risk underlying these policies. You want to talk about, if all of a sudden there's a huge deficiency, that is, you hadn't booked enough for losses last year, so now you have to make it up quite a bit this year. It means that either you were very bad about estimating those reserves in the first place, or the risks have increased substantially. Now, if you think about how this might be scored, you generally think about 1 point for every ratio in the usual range, outside of usual range, and then if you have 4 more points. But this doesn't mean that's necessarily going to get you a second look, but at least it flags it, and then it's up to the regulators to go further in this. An example is AIG, and if you look at AIG, took out the years 2008 to 2011. This information is from S&L Financial, and they calculate all of these for you in their template library. There is an IRIS ratio template, one for life and health, one for property and casualty. Now, AIG is a company that was in the news quite a bit in the subprime crisis because some of their other transactions. Now, their operating ratio is out of bounds. I highlighted this in red. And the change in policyholder surplus, they had significant losses related to the subprime crisis, and hence 2008 they had large losses out of bounds there. And you can see that they had a difficulty with keeping their liabilities to liquid assets in a reasonable range. And this again is not very, they had very poor risk management back in the early 2000s, and they were paying for it after the subprime crisis. So they really had some problems that they had to fix, and they're still working on those problems. Now for life and health, it's a little bit different. It's a little bit different tact here. You've got ratios for overall health, so you're looking at changes in capital and surplus. So the focus now is more on long-term, that cushion. Surplus, think of it as the equity, and capital in this case would be their long-term debt. And so you're looking at that cushion, which is the sum of those two, and how it changes over time. Also look at net income to total income. Total income would have all the capital gains and losses and so forth. So you look at investment income, you look at admitted and non-admitted assets. Admitted assets are those that can be counted as being set aside for policies and eligible to be set aside. Non-admitted assets are investments that are inappropriate for support of your insurance policies. And we look at the type of assets, the real estate mortgage loans, and then we'll have the number 7, you see affiliate investments, so you're talking about subsidiary investment. So how much has been invested in these other companies compared to what is available in this particular company. I'm going to skip number 8 for right now because that's a little bit of a strange one. That has to do with looking at surplus, essentially the equity account, and seeing whether it is above a certain threshold. And the idea is to make sure that you have a certain amount of surplus, and there's a dollar amount as opposed to a ratio here. Now the last 4 of these IRIS ratios for the life and health have to do with how the company changes over time, the change in the type of premium. So if you're health insurance and you have different types of health, like disability and health, medical, then you know, what is the change there in the premiums that you see over time? What's the change in the actual product mix in terms of number of policies sold? And there's complicated formulas to figure out these mixes and how the mix has changed. Asset mix is the same way in terms of what you've invested in. And then they look at change in reserving. And basically, you should be adjusting, reserving every year for experience in losses, but also, changing conditions. But if there's dramatic change in the risk conditions and the risk of the policies, then that would send the company out of the bounds, and we'll get a second look. Now, looking at Aetna, which is a life insurance company, we see that Aetna is having some difficulty in the last couple years in terms of the changes in their capital accounts and declining more than the usual bounds allow. So that would get flagged for the regulators. They had a little bit of trouble in terms of investment income back in 2008, and then they had some trouble in terms of change in premiums. So they've been losing business, and those would be flagged. Now, they only have in a given year at most 3 ratios out of bounds. So regulators could just take a pass on this. It would really depend on what everything else looked like in terms of risk-based capital standards, in terms of some of their other ratios. So there are a lot of things you could look at. There's not just one magic formula. Like ratios in general, you always have to put it in perspective of the entire company, but also perspective to how everyone else in that particular industry is doing, and then how do we put it in perspective to the economy. So you can't just use a ratio system of check off and check, this is good, this is bad, and then draw a conclusion. You really have to look at the whole picture. And the idea of the IRIS system is to look at several important dimensions of an insurance company. We're looking at the cushion to support the policies, the capital and surplus. We're looking at how fast the company is growing and changing. So we're focusing on premiums. We're looking at how much risk it's shoving off for another insurance company. So the reinsurance aspect of it, hence the difference between net change and gross changes. And we're looking at investment income, especially when we're talking about a life insurance company with a long tail type of risk. It's very important that the investment income be rather steady. Now, this is adequacy of investment income as opposed to the investment yield that you saw in the property and casualty IRIS ratios. So you look at slightly different items, and you'll see the surplus relief there. That has to do with the dollar amount, so I won't go into that. But when you analyze an insurance company, the key is to look at it in terms of safety. The focus is on the financial condition, where when we look at an industrial company, we're interested in not only the financial condition, that is, what it has in terms of assets, liabilities, and equity, and can it meet its obligations. But in an industrial company, we're focusing on the performance, all the returns, and you notice there's very little of that here. And that's because an insurance company, you're not looking for phenomenal returns. You're looking for a conservative approach. You're looking at setting the rates on a policy such that the company would be allowed to save up, basically invest those funds conservatively and still be able to meet the obligations if there's claims. And so it's a little different picture than an industrial company where we wanted to see how great a return we can get in a given year. Here it's a little different. It's how safe is the company. So the focus is a little bit different on insurance companies.